Prakash, all right. Prakash, thank you very much. Appreciate you joining in, and good speaking with you, as always, here on CNBC-TV18. Now, we have Rupen Rajguru joining us. He's the head of equity investment and strategy at Julius Baer. Rupen, good to have you with us here. Thank you very much. I believe, your view is that the markets here in India will underperform global markets. Broadly will be range bound. But I want to start with how you're viewing the third quarter earnings which are coming through, Rupen, because as I'm seeing it, there are far more number of downgrades to upgrades. We'll put that data out later once this week is out. But how are you and your team viewing the earnings so far?
Okay, hi. Good afternoon, Prashant. So you're right in saying that the third quarter earnings have been a mixed bag. I think the big shining star in the quarterly earnings are financials. And we have seen record profits from both public sector banks as well as private sector bank. Probably, the largest bank, touching the ROE touching 18%. I think it's a big number. While we have financials and automobiles which have done exceedingly well in this quarterly earnings, but clearly we have seen some of the consumer discretionary companies are facing a bit of headwinds. So the select QSRs, retail, have shown some signs of struggle in this quarter. So while on an aggregate basis, because of very strong numbers by financials, I don't see a significant cut in our, the Nifty earnings estimate for this year. But we have to, coming back to your original question, on India and the relative underperformance. And, this is the year, Prashant, what we are seeing is the year in which,
Rupen,
we are...
Sorry. Rupen,
Yeah.
Rupen, if I can just, sorry, on that question on financials, right? I went back and looked at, numbers are strong, absolutely. But are these numbers leading to upgrades for FY24? That is what matters, right? Upgrades or downgrades for how you would value the company. Take a look at this. And these are companies, I think, which have reported. ICICI Bank, no upgrade. I looked at Axis Bank, no upgrade. HDFC Bank, 0.19% upgrade. IndusInd Bank, this is, by the way, as compared to the pre-quarter. So basically about a month ago. IndusInd Bank, no up. The only bank which is seen, at least in the Nifty, which is seen an upgrade is SBI, and that is about 3.5%. So, it's more like no downgrades, but no upgrades as well, even in financials. Go on, Rupen. Finish that point.
It's a fair observation, Prashant. But even if there were to be no upgrades, if you see also the growth which the analysts have built in for next year for FY24 for financial is pretty robust, right? So it's not that they are not expecting any growth. You're right in saying that there hasn't been any upgrades, but I would say at an aggregate level, this quarter earnings has not led us to change any estimates so far for FY23 or FY24 as far as the earnings is concerned. So ultimately, it all boils down to how does the India valuation stack up vis-a-vis the global market, right? Because you're right, if there were to be more upgrades, then we might see the market momentum. And hence, we are seeing the market is where it is, right? We have hardly seen a 1% negative movement so far in this calendar year for India. And that's precisely the reason for that.
Okay, got that point. Market for the time being is still holding up. Actually, it isn't moving much. Just about a 1% up move on the Nifty continuing. The mid-cap index is in step with the Nifty and the Sensex, and Bank Nifty is slightly better off, but still just a 0.25% higher, not in sync with the rest of the screen. For the time being, let's focus on an Adani Group company that continues to be in the headlines, and we're talking about Adani Ports. It is, of course, one of the top index gainers today. Vivek is here with the highlights from the company's conference call yesterday. Vivek, I suppose their decision to go slow on capex, repay some debt, that's been very well received by the market today.
Well, absolutely right. What actually happened is that the key worry as far as market participants were concerned was the guidance, and the management, actually assuaged all investor concerns on that front. So what's actually happened is that the management maintained its FY23 revenue as well as EBITDA guidance. You remember the revenue guidance was in the range of 19,200 to 19,800 crore, and EBITDA guidance was in the range of 12,200 crore to 12,600 crore. So FY23, that is being maintained. Also, what the management has done is they've introduced the EBITDA guidance for FY24, seeing a strong growth. So they're expecting EBITDA in the range of 14,500 to 15,000 crores for FY24. Along with that, what they're actually expecting is that net debt to EBITDA is going to be reduced to 2.5 times by the end of FY24, which at the end of FY23 they expect to be around 3.5 times. So again, net debt to EBITDA coming down is also being seen quite positively. Brokerages naturally were enthused. CNBC upgraded the stock to a buy stance. What they said is the key takeaway from the third quarter call was the fact that number one, FY23 guidance has been retained, and now the company is resolutely focused on bringing down the net debt to EBITDA ratio to 2.5 times versus 3.5 times earlier. Back of that, you're seeing the stock move up quite significantly in the session today.
Okay, all right, Vivek, thanks a lot for that. Well, Rupen, I'm reading some of your comments, and you were talking about buying select stocks on dips as well as some tactical trades on swing sectors could be beneficial. Well, if you got into this Adani group close to around 7 days ago, you'll be dancing away to the bank. I'm not talking about before that. But, that swing trade did play out, particularly in stocks where, the core business was good, whether it was Adani Ports, ACC or Ambuja Cement, so just name a few. What's your view on the group? If there's something you like out there? And also, do you think most of the bad news with regard to the group and its impact on the markets, that's behind us for now and things are under control?
Hi, afternoon, Nigel. I would refrain from commenting on particular sector or a stock or a group. But here, and as you rightly said, that amongst the various assets which this company had, the port assets was the most valuable and also had good cash flows, and that's what market is taking into cognizance. But if I were to step back and see, I think there was big swings in the group stocks post the report, but it did sour the sentiment as far as India is concerned. But having said that, what we have seen it in the past, Nigel, that people do tend to have short memories. So probably 10 days down the line, it might be business as usual, and we might hopefully not be discussing this stock with this much intensity the way we are discussing, but where we have been discussing for last 10 days. But from a stock market perspective, usually we see definitely, in some of the group companies, the valuation was much inflated, and that valuation correction which some of the group companies saw probably was warranted. But as I said, we do just a caveat or a disclaimer here: we don't have any coverage on any of the group stocks, so no, we don't have a formal view on the any of these companies.
Rupen, from the stocks that we just spoke about, ACC and Ambuja, they are the cash flow generating companies. Free cash flows churning up of close to 4,000-5,000 crores every year. Plus, they're sitting on cash as well, so they offer some margin of safety. Since you're not commenting on any particular stocks, but what about the sector? I was on the con call, Ambuja Cement's con call earlier, and I wish that the lines were a little bit clearer because it kept logging off and on. But the broad message you got from them is they are looking at capacities, and they're looking at doubling capacities from year on, which the market is a little bit doubtful on. Given that incremental capacity may not come on, do you believe that the cement sector will look up from year on? You had a good budget, maybe the worst of input costs are behind us, and volumes will pick up. Your take?
No, you're absolutely right in your observation, Nigel. In this financial year, if I were to take a rough breakdown, the overall input cost for cement companies at an aggregate level went up by almost 22%, whereas the price hikes were only to the extent of 10%. So what that led to, if I were to just take quarter two's total number, the EBITDA per ton crashed from 1,200, 1,300 rupees per ton to almost 600. Probably in this quarter, we are getting into that 800, and we might exit this year at closer to 2,000 per ton. We are clearly seeing the input costs kind of getting now into the base, and we are seeing that improving. Secondly, you are right that once the acquisition of the second largest group happened, Holcim Group happened, all other incumbent companies announced huge capex, and all want to reach. The largest company wants to reach 200 million ton. Others want to reach the 100 million ton. In fact, Holcim Group also had a vision to have close to 150 million ton capacity. So all those, everybody accelerated their plans because they expected disruption. But now probably the disruption will not be as intense as what was feared. So that supply pressure is definitely there, but not as bad as what it was anticipated. Having said that, coming to the growth, if you look through the kind of big capex announcement which the budget has mentioned, all coupled put together, we expect a very strong volume growth for the industry. And from here on, from next 2-3 quarters, we expect every quarter the EBITDA per ton to move up from the current level. So yes, we are constructive on the sector per se, and the pace or the intensity of capex or expansion planned, if that tapers off, it should augur well for the sector.
Okay, Rupen, good talking to you today. Thank you very much for joining in with all of that perspective. Appreciate your thoughts. Well, the market is holding on, not too much changing. We've still got a gain of about 150 on the Nifty.